Renovating Retirement with Charlie Jewett. Oh no, I think I'm about to have another episode.
Yeah, Uncle Sam, I have something really important I want to talk to you about. It's about us. I'm just not feeling it anymore. In the beginning, when you wanted to take a giant chunk of my money, it was all fun and games and it was good. But the honeymoon phase is over. I don't think I like you taking my money anymore. Uncle Sam, I don't want you anymore. I want a divorce.
Hey, it's not Fat Albert. No, it's not. It's Charlie Jewett with Renovating Retirement. Coming to you after a long break. I'm so sorry. This is going to be episode 72, about 5 days late. Why is it 5 days late, you bad podcaster? Well, I am first a father, and don't even know if it's second, but somewhere after being a father in level of importance, I'm a podcaster. I've got 2 children, a boy and a girl, a pink one and a blue one. Yay. And I promised them this year, Daddy would take each one of them on a 1-week vacation somewhere wonderful in the world. These past 2 weeks were those 2 weeks. I'm actually in Hawaii right now in the middle of the second week with my son. They are work vacation weeks, and I'll tell you one thing. The first one was in Chicago, and then I had 15 hours to switch kids, and then I went to Hawaii. 5-hour time difference, working all the time, having the kids full time, and trying to have fun. It made it hard for me to do the podcast, so my apologies. But I'm a daddy first and a podcaster second, so now I'm going to jump back on track and start delivering you some massive content. I don't know if it'll be massive content. It'll be awesome, though. So, episode 72, what the heck are we talking about, baby? We're still talking about taxes, although tax week might be dragged out into tax 2 weeks because I took a long break. But episode 72 is called Divorcing the IRS Using Roth Conversions. Ooh, if I had a crowd, they would go wild. What are Roth conversions? Roth conversions are very simply you telling the IRS, I don't want to be married anymore. I don't want to share all my stuff with you. I want you to leave me and leave me alone. And everything I get from there on after is mine. All the stuff we have together right now, our communal property, let me just pay you and get rid of you. You can have some of it. I'm going to keep some of it. But the some of it that I'm going to keep all of it for the rest of my life. You do whatever you want, but the some of it I pay you to get out of my life. And it's kind of like that. You just tell the IRS, I don't want to play this game anymore. I know you swept me off my feet and told me that I was going to postpone taxes to a later date when I was going to be in a tax bracket. But then after we got married, you changed, Uncle Sam. I don't like you anymore. You're a beast. And you say, I don't want to be married. So if you have IRAs, 401ks, 403bs, 457s, TSPs, if you have anything where you made an agreement or an arrangement to save taxes when you're putting in little contributions, and then you're going to pay taxes when you're taking out giant withdrawals for income, and you say, I don't think I want that anymore because I think taxes are going to go up. It's time to get a divorce. Now, who can do this? What are the limitations on converting your IRAs or all of your pre-tax money to Roth IRAs where you'll never pay taxes again on the growth or the income or the transfer to loved ones? Who's allowed to do it? Dun, 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 dun. As of today, it didn't used to be this way, but as of today, anyone who wants to can do this. There's no net worth limitation. You can't be too rich to do it. You can't make too much money to do this. So this is awesome sauce. You just decide, do you think taxes are going to be higher later, or do you think taxes are going to be higher today? Work with your CPA or tax professional. I can help and say, what tax bracket am I in? How should I convert these things? Now, if you've got a $1.5 million IRA, or you've got a $500,000 IRA, or even $300,000 in a 401k, and you want to do this, should you do it in 1 year? Probably not. At the recording of this podcast, if you were to convert a $300,000 IRA, let's say, to Roth IRA, which is a very simple process. You call up the company that has it and say, I'd like you to flip the switch, please. Maybe there's a piece of paper to sign. Maybe they just do it for you. It's quite simple. The IRS, by the way, always makes it simple to pay taxes. It's hard to do everything else, but paying taxes, to them, they make pretty convenient. So you say to whatever your custodian is, whoever's housing the money, whoever's name is on the statement, you say, can you make it a Roth IRA? They go, sure we can. Flip. All of a sudden, it becomes a Roth IRA. There's a IRA to Roth IRA conversion. And then next, February before tax season in April, you get a big fat bill. and you've got $300,000 extra income for the year on top of everything you normally make in any given year. So having an extra $300,000, $500,000, $1.5 million of income in any given year for any person in any tax brackets, it's going to push you into kind of a high tax bracket for a lot of those dollars. So when we're working with a tax professional and your advisor or myself and you, when we're teaming up trying to say, ooh, how do we convert these things? A lot of times a very basic strategy is we're just not going to do it all in 1 year. We're going to spread this out over 2, 3, 4, 5, 10 years to try to keep, split it up into little pieces so we're raising your income by smaller amounts and not popping you up into the higher tax brackets. That's basic strategy number one. Now, when I do annuities for people or when I'm working with other advisors and showing them what to do with annuities, I don't do big, giant annuities for $500,000 or even for $200,000 or for $1.5 million or for $1 million. I chop up the annuities into smaller pieces. I tend to want the annuities to be about $50,000 to $75,000 a piece. So I've done 5 annuities for people. I've done 12. Right now I'm doing one that's 20. The people above me don't like it. It's a lot more paperwork. The insurance companies don't like it. It's a giant pain. The thing is, the reason that I do this, the strategy has multiple benefits, but the strategy of multiple smaller annuities instead of one annuity comes from Roth conversions. If you want to convert an annuity, so you have guaranteed lifetime income or guaranteed lifetime increasing income, if you want to convert an annuity from IRA to Roth IRA, it's all or nothing. You can't call up your annuity company and say, yeah, I've got a $400,000 annuity with you. Can you take about $50,000 of that and convert it to Roth IRA this year? I can't do cricket sounds. My lips aren't warmed up, but you would hear cricket sounds. They will say, no, you have to do the entire $400,000 or none of it. That's a problem. You don't want $400,000 of extra income in this year. So the very easy fix. The insurance company doesn't like it. The people above me don't like it. It's a pain for you, but it's a one-time pain of doing multiple applications. Then you have multiple annuities. Maybe instead of $400,000, you've got 8 annuities at $50,000. Ooh, baby, it gives you lots and lots of flexibility in Roth conversions. In income, turning on income from some of them, postponing some of them to keep growing, and using the long-term care benefits from some of them and not other ones. It has all kinds of cool benefits, but the number one reason I do this is because you can call up and say, can you convert one of my $50,000 IRAs to Roth IRA? And they say yes. You have an extra $50,000 of income that year. Go ahead and pay your taxes and get a divorce from the IRS. You just buy them out at 15 grand or 20 grand or whatever it is. Then next year you do another one. The next year you do another one. The next year your income is unusually high for some reason. You just don't do one. You get full flexibility of using, looking at your income at the end of the year, saying how much room is there left until I hit the next tax bracket and deciding whether or not to convert. Also, you can watch where taxes are going. And if taxes look like they're going up and you've converted 3 of your $50,000 annuities to Roth IRA, and then all of a sudden taxes plummet to lower than they've ever been, you stop. You don't do any more conversions. So that's that. Now, are there creative ways to pay the taxes? Say you're getting out of a $400,000 IRA over several years, you might owe $100,000, $150,000 in taxes. Are there ways to lower that or to use tax deduction strategies to cover that? Yes, there are. How do you pay the taxes? Well, number one rule is you probably don't want to pay the taxes out of the IRA itself, meaning if you're converting a $400,000 IRA to Roth IRA, let's say you're going to owe $150,000 in taxes, we don't really want to pay the taxes out of the IRA so that you end up with only a $250,000 Roth IRA. We'd like you to have as much money inside the Roth IRA as possible because it grows tax-free, income is tax-free, transfer is tax-free. So if you're converting a $400,000 IRA and your total tax is going to be $150,000, really it's better to pay that with outside money, some type of other money. So what other money do you have in your life? Well, you've got money that's just normal after-tax money, maybe sitting in the bank, maybe sitting in brokerage accounts, things like that. That's better money to divorce the IRS with and then to keep the size of your IRA or the size of the new Roth IRA as big as it can possibly be. If you have to use IRA money because that's all you have in your life, then so be it. You have to use IRA money. Now, you'll have to talk to your tax professional or CPA, but can you take a home mortgage either a home equity line of credit or refinance and do a cash out refinance? Can you take the $150,000 or whatever you're going to owe out of your home and use it to pay the taxes to get this divorce with the IRS? Maybe you can. You probably can if you have the equity. Now, can you deduct that? Can you actually get a tax deduction for making payments on money that you used to pay taxes to get a divorce? Worth looking into. Ask your CPA, ask your tax professional, do some research, see if you're in your situation, you're allowed to do that. What about reverse mortgages? Going way back to the beginning, in the early days when I was first a podcaster, walking uphill both directions to the studio. In the early days, I did an episode called Are You an A Planning Family or a B Planning Family? Just a quick review. A planning families need the money in their life to create income. They've saved up $500,000, $700,000, $1.5 million, whatever it is that they've saved up. They look at that and say, I need to create income while I'm alive primarily. I don't have enough income once I quit my job. So my assets are for income, and whatever's left over can go to the loved ones as an inheritance. B planning families look at all the money they've saved up in their IRAs and stock accounts, their entire nest egg. They look at it and they say, I don't need any income from this. I've already got pensions and Social Security. I've got crazy income from rent or whatever. My bills are paid from existing income once I quit my job. This money is for inheritance. It's for legacy. So B planning families are maximizing the size of the estate when they die. They don't need income. A planning families are maximizing the income while they're alive, even if there's nothing left over when they die, but they'll leave whatever's left over to their loved ones. Very, very important, because reverse mortgages, which get a bad name from people that don't understand them, are an incredible tool for A planning families. They have amazing assets for income while you're alive or lowering your bills while you're alive, so you're keeping more of your income. The only negative is you may not leave as large of an estate after you've passed away. So that being said, if you're an A planning family where you have the assets in your life, you need them for income during retirement, could you switch to a reverse mortgage so that you don't have a mortgage payment anymore? Maybe you're eliminating a payment of $1,000, $2,000, $3,000 a month. Could you switch to a reverse mortgage, then do Roth conversions a little bit every year, and just pay the taxes with the money you used to pay towards a mortgage? Yes, you could possibly. Or if your home's paid off, are you allowed to take money out of the home each year or in a lump sum, whatever they allow right now with reverse mortgages, to pay taxes as you convert to Roth IRA? You possibly could, couldn't you? There are infinite ways that you could do this. You have to ask yourself the litmus test first. Do you think taxes are going up or down? If you say up, you want to consider divorcing the IRS. Do you want to be in a higher tax bracket or the same tax bracket? Basically meaning, do you want to have the same income you have now or better as inflation goes up? If you say yes, you want to consider divorcing the IRS and saying, I'll take the Roth IRA instead of the little stupid IRA where you take all my money. If you think taxes are going to plummet, ignore the entire episode. If you need help, get in touch. Charlie at meritplanning.com, CHARLIE at merit, MERIT, planning.com. Or you can follow me on Facebook at Jewett Wealth Management or Renovating Retirement, or on Twitter, tweet, Reno, RENO _retirement. Other than that, that's all I'm going to talk about today, getting back on track after vacations with my family. I think you people are the best.
Renovating Retirement with Charlie Jewett.
But that's all, folks.